Can you talk a little bit, because the business model for monetary metals fascinated me when at first I didn't fully understand it, but can you just talk a little bit about, what is it that you guys do over there?
Well, it's interesting. If you think about physical gold, there's about $13 trillion worth of it laying around at the current per ounce price of $1,930. So if you take all the gold in the world, physical gold, held by sovereign governments, by central banks, by individuals, by companies, in sock drawers all over the world, it's about $13 trillion. And most of it's just sitting around. It's doing nothing. And a lot of it, people are even paying points to store it or keep it in a safe deposit box or keep it in a private vault to insure it, all these things. And you think, well, governments have beaten down gold and not allowed it to be used as money any longer. And so if you were to ask a central banker if gold was money, he would say, no, it's a precious metal or it's a commodity asset or something like that. But he or she would not say it's money. Okay, well, in the legal landscape in which we live in the West, I guess that's true. But nonetheless, it's very stubborn. It retains this monetary aspect to it. And I think that explains why central banks continue to hold it, regardless of what they say. In other words, Ron Paul once asked Ben Bernanke, why does the Fed hold gold? Why does it continue to hold gold? And Ben basically said, well, that's a relic. It's a remnant of past practice when we had a gold standard. We had some measure of gold convertibility. But I think it's interesting that they haven't dumped it all since 1971. And so gold still has this moneyness to it. And as a result, I think the idea behind our company and our founder, Keith Weiner, was, hey, why can't we put some of that gold to work? Why can't it be used to collateralize transactions, to collateralize insurance companies, to provide inventory for gold or silver jewelers for manufacturing or industrial uses? Why can't it be used in bonds for gold mines or refiners that actually produce finished gold bullion, for example? And so all these questions came to mind, and he started a company based on this idea. So we provide, oftentimes in the form of a lease, we provide gold or silver to a user, to a jeweler or an industrial user, and they have that as their inventory. So they don't have to go spend their cash on inventory. They can get gold or silver from us in physical form. They also can use that cash that's then freed up from inventory to do all kinds of things like make payroll or invest in CapEx or whatever it might be. They don't have to tie it up in inventory. And then also they know their cost for the period of the lease. So let's say it's a 1-year lease. Let's say it's 10,000 ounces and we charge them 7%. They know that over the course of the lease, they're going to owe us 7,000 ounces in addition to returning.
Can I stop you right there, Jeff? I just want to underscore, because I'm sure a lot of the listeners just automatically in their head, when you said that, assumed you meant looking what the spot price of the gold or the silver was, and that's what no. When you say they're agreeing to the terms of the lease at 7%, this is the units are all in weights of the metals.
Yes, we are quoting and paying our leases to our investors in ounces. So if they have a 10,000 ounce lease with us at a 7% lease fee, then they're paying us 700 ounces additional when they repay the 10,000 ounces. So they know up front that they simply have to replace those ounces. They don't have to worry about the cost of gold going up and down because they're going to be buying it at market price whenever they purchase it to return our inventory or to pay interest to us. And so as they produce a product, let's say a jeweler produces gold jewelry, they take that out of our inventory at then market price. They produce it, sell it at then market price, replace the 1 ounce, let's just say, at then market price. So they don't have to worry about the price fluctuation during the year. Whereas if they simply use their own cash, put a few $1 million into a couple several thousand ounces of gold, and then during the process by which they were producing jewelry, gold went from $1,930 to $1,500 or something, all of a sudden their inventory would take a huge hit, the value of it. And so they would have to have a big write down for accounting purposes on their inventory. So it also, not only do we provide a way for them to free up their cash, but we also provide a level of certainty for their cost of inventory for the period of lease.
And again, just to make sure that, because this is something, the reason I'm stressing this is for whatever reason, it wasn't clicking with me when I first heard the model, because I was thinking it's not like sheep. Like I get how if you have 100 sheep and then, you tend them right and they physically multiply. But with this, but yeah, it's because the people who are taking out the leases are in, they use the physical product, like you're saying, so that the fluctuations kind of cancel out. That yes, in one sense, like, oh, I thought I had to pay back 700 ounces when gold was 1900, and now that it jumped up to 2500, that's more expensive in dollar terms than I thought. But like you're saying, by the same token, okay, but what they're sitting on also appreciated by the same amount, and so it kind of cancels out.
If they're selling an item of jewelry that has 1 ounce, presumably their sale price on that item has also risen with the gold price.
Right.
And Bob, gold can't reproduce itself like sheep. It just sits there. It's a shiny rock.
That's what I had to understand.
Even with 3D printing, we can't make gold.
Right. So, okay, so you're explaining, and then like similar, like another typical customer for you on that end of the business would be like a mine or something. Can you explain how that works?
That would be more of a bond situation. Let's say a mine needs to raise $10 million. So they want to go for operations. So normally they would go out into the financial markets and either borrow that and pay interest on it from a bank, or they would issue a bond and pay interest on the bond to bondholders. So instead of doing that in cash, we're simply able to do that in ounces of gold that they need for their operations. And then we can also charge them interest in gold so that, again, they're in the same situation as the jeweler using it for inventory. They don't have to worry about price fluctuation. And so the point here is that, especially with a gold miner, I've spent a fair amount of time looking at gold mining stocks, which tend to be smaller companies. There are big ones, but the smaller ones tend to be where everyone thinks there's a huge upside in the price. And there's a lot of consternation over the fact that gold mining stocks don't necessarily track the rise and fall of the spot gold price. And a lot of them tend to struggle. They're undercapitalized. Sometimes they go out of business altogether. And so it just strikes me that we're trying to put the gold that's already up here, that's already been mined, that's already been refined, that has already been converted from doré into bullion, whatever it might be. We're trying to put that gold to use. So you don't have to go invest in a miner. You don't have to go find out where it is. You don't have to worry about a mine being nationalized or being undercapitalized or anything like that. Let's take the gold that's already here, $13 trillion worth of it, laying around unused. And even the most ardent monetarist, the most ardent opponent of the gold standard, even the most hardcore MMT advocate, for example, would admit that gold is an asset, that gold has a price, and that I think in their heart of hearts, they'd admit that it's kind of a financial asset, that it has an element of moneyness to it, even though we've gotten rid of the gold standard and any notion of gold deemability in the West. So we're trying to use gold, trying to put it to use. Everybody out there right now in capital markets is desperate for money. If the IPO market has cratered somewhat, the startup market, the venture capital market for small companies, 20 years ago in Silicon Valley, it was not nearly as difficult to raise equity capital from investors. But if you talk to people in that world, if you talk to people in the world of private equity, venture capital, family offices, et cetera, they will tell you that just as with the commercial bank lending, private investment, I wouldn't say it's dried up, but it's a lot more difficult. It's a tougher environment than it was just a few years ago. And so we're hopefully going to provide an alternative to that using an asset that's already there. Again, this gold is laying around. So I hope...
Hey everybody, this is Bob Murphy. Thanks for listening to this clip from the InFi podcast. If you like what you heard and want to hear more, please consider subscribing and share this video with others. We've got new episodes dropping every Friday with more insightful discussions. Stay tuned.